Welcome, everyone. Great to have you here. I'm Chris Ashton, the head mentor at the Corellian Academy. Today's session is the fourth of 5 webinars focused on using technical analysis to help you trade CFDs on the Plus500 platform. If you would like to see the previous 3 webinars in this series, there is a link to the Plus500 YouTube channel on the Zoom chat for you right now. By using that link, you can see all of our previous webinars, not just on technical analysis, but specific markets like oil, gold, and US stock indices. The final webinar in this series will be on Monday, December the 15th, so we hope that you'll be able to join us for that as well. Before we dive in, a quick bit of housekeeping. Today's presentation will run for around 20 minutes, and I'll wrap up with a live Q&A where I'm joined by Richard Adcock, who is Corellian's technical analysis mentor. So if anything sparks your curiosity, drop your questions into the Zoom chat or the Q&A panel as we go. And just remember, trading CFDs carries risk. This webinar is purely educational. It's not meant as financial advice, so always trade responsibly. Great, all set, let's get started. So today's focus is using technical analysis to aid risk management. Put simply, I'll be exploring how technical analysis, the tools, the patterns, and the price behaviors I've covered in our past sessions can actively support smarter risk management in your trading. Why this topic? Because risk management isn't a luxury, it's about survival. It's what protects your capital, enforces discipline, and ultimately allows you to grow as a trader. Think of it as the first or the foundation that keeps you in the game. Not every trade will be profitable. Unfortunately, that's a reality. But with solid risk management, you can limit the size of your losses, you can stay in control, and keep trading with confidence, even through the tough or volatile trading environments like we've seen at the start of November. Here's what I'll cover over the next 20 minutes. I'm going to break down risk management, what it really means, and how you can apply it practically in your trading. I'll look at stop losses, risk-reward ratios, and position sizing and volatility. Then I'll shift the focus deeper into technical analysis and cover a powerful tool called Fibonacci retracements that can help you to guide your trade entries, exits, and most importantly, your risk levels. And finally, I'll bring all this together using a gold case study, where I will walk through how Fibonacci techniques could have helped traders to manage their risk more effectively when trading gold. Okay, let's get into it. So what's risk management? It's a term in trading that refers to strategies and practices used to limit potential losses and protect your trading capital. It's a core component of any successful trading plan, helping traders survive volatility and stay consistent over time. Why does this matter? Well, without risk management, a big loss can wipe out your entire trading account. However, it's not just about avoiding losses. It's about staying in the game long enough to let your trading strategies play out, ideally to achieve a profitable outcome. Preserving your capital by pursuing a disciplined, consistent approach to trading, supported by controlled risk management, can help to build long-term profitability. Okay, so what does this all involve? Well, risk management involves 3 components. First, it's identifying the risk. This means recognizing that there is a potential for loss in every trade due to market volatility, news events, or even execution errors. The next thing is to measure that risk, where you calculate how much of your capital is going to be staked on every trade. And this is often expressed as a percentage of your total capital. And then it's controlling the risk, using tools like stop loss orders and position sizing to limit the downside exposure on any trade that you may be running. There are several core principles every trader should consider regarding risk management. Now, while the following list is not exhaustive, it does help to frame some of the important points that you can adapt to your own trading style or circumstances. After all, it is important to recognize that every trader is different, and what works for one individual trader may not work well for another. Okay, so principle 1. As a general rule, aim to risk only 1 to 2% of your total capital on each trade. Why? Because it protects your account from large drawdowns or losing trades and gives you the staying power to survive losing streaks, which every trader, no matter what their experience, will suffer from time to time. For example, if you lose just 2% of your capital on a trade, you only need to make 2.04% gain on the next or on the remaining capital to recover that previous loss. However, if you lose 20% of your capital on a trade, you need a 25% gain just to break even on your total capital. On an emotional level, smaller losses are also easier to bounce back from. Please keep in mind that losses compound against you. The deeper the drawdown or loss of capital, the harder it is to recover. So risking smaller amounts, for example, that 1 to 2% of total capital per trade, keeps the loss recovery realistic. And as I said right at the start of the webinar, preserving capital is important. This principle is a cornerstone of professional risk management. Principle 2, always use a stop loss. It is your safety net. A stop loss order is your automatic exit strategy. It closes your position at a predefined price, capping your downside and protecting your capital, especially in volatile markets while prices can flip fast. Why can using a stop loss be so important? Well, it prevents a single bad trade from spiraling out of control, while it also acts as an emotional buffer, meaning no more agonizing over when to cut a bad or losing position. These orders helpfully can be preset on the Plus500 platform in advance for extra peace of mind. Best practice when using stop losses is, if you have a long trade, place your stop loss just below a key support level you've identified, and for any short trades that you're running, place them just above a resistance level that you've identified. One key suggestion is avoid placing stop losses at random levels based on arbitrary percentages or what you can afford to lose. This approach risks getting cut out by choppy price moves. Remember, stop losses aren't just tactical, they can also be psychologically beneficial. They let you trade with clarity and not trade with fear. Principle 3 is adapting your position sizing to market conditions. Remember, sizing the position isn't just about how confident you feel, it's about taking what the market is offering you. In normal market conditions where price action is relatively stable and predictable, you can consider taking slightly larger positions if your risk management is strong and your stop loss is well placed. In this environment, your risk per trade should still be capped. For example, as I suggested earlier, using 1 to 2% of your trading capital. In volatile markets, while price swings are much wider and less predictable, it can be advisable to reduce your position size, even where your conviction is high. In this situation, widen your stop loss to account for increased noise, but keep your risk per trade constant. Remember, volatility can punish overconfidence. Avoid the temptation to make back losses by increasing your position size and taking bigger risks. In these situations, your risk per trade stays the same, but your position size adjusts to the level that you have identified for your stop loss. That's how you stay consistent even when the market isn't. Discipline in sizing is what separates traders who survive from those that don't. Now I want to talk about risk to reward ratios. These ratios are the backbone of disciplined trading. They help you evaluate whether a trade is worth taking, not based on emotion, but probability and the payoff. These ratios is the difference between what you're willing to risk on a trade or lose on a trade and what you stand to gain from putting that trade into the market. For example, a ratio of 1 risk 1 to 2 reward means you risk $100 to potentially make $200. 1 to 3 ratio means you risk $100 to potentially make $300. The higher your overall risk reward ratio, the more forgiving your win rate can be, as can be seen on the chart on the screen for you now. Ideally, you never want to trade with a risk reward ratio that means you are risking more than you're potentially going to make, as over time, this will erode your total capital. Pursuing a positive risk to reward strategy keeps your trading decisions grounded in logic and not impulse. It helps you to filter out low quality setups and can help to promote long-term profitability, even where your win rate is below 50%. To achieve a positive risk to reward ratio, the best practice is usually to set your stop loss first. So you define your risk, then identify a realistic take profit target based on, for example, technical levels like support and resistance, Fibonacci retracements or extensions that I'm going to talk about in a minute, or moving averages. Only look to activate trades where the potential reward outweighs the risk, ideally 1 to 2 or better. Remember, you're not just trading setups, you're trading those probabilities. Risk reward ratios help you to stay selective, disciplined, and focused on the bigger picture. Okay, that's risk management. Let's focus on adding a new technical analysis technique to your toolkit. One that not only helps identify opportunities, but also reinforces your risk control. Here, I'm talking about Fibonacci retracements. They aren't just lines on a chart. They're a way to anticipate potential turning points in price, helping you to spot logical entry and exit zones, set smarter stop loss levels, and align your trades with the market. Whether you're trading gold, indices, or FX pairs over any time frame, Fibonacci retracements can help you to stay structured, selective, and risk aware. Let's break down how they work and how you can use them effectively in your day-to-day trading. So Fibonacci retracement levels help traders identify potential support and resistance zones during a trend, areas where individual CFDs price might pause, reverse, or accelerate. These levels are based on ratios from the Fibonacci sequence, which is a mathematical pattern found throughout nature, art, architecture, and even the human body. Because financial markets are driven by human behavior and human behavior follows patterns, these Fibonacci levels can help you to spot logical pullback zones within a price trend, set more precise stop loss and take profit levels, and structure your trading decisions, especially when volatility kicks in. Let's break down how these levels are calculated and how to use them in real-world trading. The key Fibonacci ratios for retracement ratios for you to know are the 38.2%, which is the moderate retracement, the 50%, which is the psychological midpoint, and the 61.8% retracement, which is the most important one, which is also known as the golden ratio. So how do we draw these Fibonacci retracements? Well, you simply start by focusing on a significant swing low and tracing it up to a significant swing high in an uptrend, or a significant swing high to a significant low in a downtrend. Your Plus500 chart will calculate and plot these levels automatically. As an example, let's look at a recent daily chart for UK 100 and plot the Fibonacci retracements from the September 2025 low into the October high. The way to view Fibonacci retracements is as identifying support levels within an ongoing uptrend and resistance levels in an ongoing downtrend. Within this example of the UK 100 index, we are using the Fibonacci retracement to highlight support levels. The way to use them is to monitor the 38.2, the 50%, and the 61.8 level retracements within any price correction, and anticipate each to act as a support level to potentially limit or even reverse price weakness. However, one thing for you to know, if the support offered by the 38.2% level is broken, the risks are for tests of the 50% level, which should then be viewed as the next support. If breaks of this level are then seen, it suggests potential for deeper declines to the 61.8% level. As I've already said, the 61.8% level is regarded as the most important retracement because if this gives way on a closing basis, the potential is for a more extended phase of weakness back to the original significant swing low support that you have identified at this start. As you can see using this UK 100 chart on screen, the test of the 38.2% level at 9,430 on October the 11th initially saw it act as a key support and attempts at fresh price strength were seen. However, with the full recovery failing and fresh selling pressure developing, this 38.2% level, the support gave way. This led to prices moving to the 50% level at 9,370, which was then broken, exposing tests of the deeper 61.8% level at 9,314. Interestingly, it was this level that successfully held the price decline and prompted fresh buy-in support, a move that eventually saw breaks to new all-time highs. It's at this point I want to discuss Fibonacci extension levels. These operate like Fibonacci retracements, but are useful when a CFD breaks to new all-time highs, and there are no obvious resistance levels because the asset is effectively in uncharted territory. Extension levels use the same ratios as the retracements, the 38.2 and the 61.8, but are projected to the upside within an uptrend or the downside within a downtrend. Let's plot these using the same UK 100 chart. To do this on the Plus500 charting system, click on the Fibonacci extension button here and use the last correction move lower in price as the starting point to calculate the ratios. Again, the system will automatically calculate these for you. You just click on the low of the last correction move, which in this example was posted on October the 17th at 9,308, and move back up to the high, which was previously touched on October the 8th at 9,620. Click twice on the high and you will see the Fibonacci extension levels are plotted on the chart for you. These extension levels can be used as indicative resistance levels to price strength within an ongoing uptrend, such as the one that we have been experiencing in the UK 100 index. In the same way as before, if the 38.2% extension resistance is broken, risks turn towards tests of the 61.8% and further if this is in turn breached on a closing basis. Interestingly, in the case of the UK 100 index example, it has been this 61.8% Fibonacci extension level that initially held the advance at the start of November and prompted fresh weakness before further upside again resumed. Now that's both Fibonacci retracements and extensions, and the main takeaways of this popular technical analysis technique are on screen for you now. I'd suggest practicing trying to run these on your own Plus500 charting system to gain more experience, or use the excellent live Plus500 demo account to see how they may work best for you in practice. Okay, so how can we apply these Fibonacci retracements and use them in building a structured trade plan? Now, I have already discussed how to use Fibonacci retracements as indications of potential support in an uptrend or as resistance in a downtrend. And this then allows us to use these levels as initial entry points for any trade we may be looking to establish. For example, one of the key advantages of waiting for a price correction back to a support level in an uptrend, say back to the 38.2% Fibonacci retracement, is that it gives us a more favorable entry point than simply chasing price strength. If you're looking to go long, just ahead of that 38.2% retracement support, you already have an indication of where the next key supports may lie in the 50% and 61.8% retracement levels. This gives you a potentially logical place to set your stop loss just below those levels. This foresight is powerful as it means you can define your entry, your stop loss, and risk before you place the trade. You adjust your position size to stay within your, for example, your 1 to 2% capital risk rule, and then can trade with confidence, knowing your exposure is controlled from the outset. In fact, because your entry is closer to your stop loss, thanks to the pullback, your position size may be larger than usual, but your risk to the total capital stays the same. That's the benefit of combining structure with discipline. Once you've defined your risk, you can set your reward. You can decide to apply, for example, a 1 to 2 risk to reward ratio to calculate a logical target, or aim for a Fibonacci extension level like the 138.2 or 161.8% retracement as a potential exit zone. This may even offer a 1 to 3 risk reward or better, meaning a greater profit potential for the same amount of risk. The bottom line here is this is how you trade with a plan and not trade with emotion. You're combining technical structure with risk discipline, and that's what gives you or helps you to maintain your staying power in the markets. After all, trades based on emotion may be profitable over the short term, but emotion isn't a consistent trading strategy. Now, before I wrap up, let's bring everything I've covered to life using a real-world example of gold. Here, I'll take a look at a recent price activity in gold and explore how those Fibonacci retracement and extension levels could have helped to identify potential entry points after a correction, set logical stop loss levels beneath key retracement zones, and define profit targets using Fibonacci extensions, offering structured, high probability exits. This is where technical analysis meets risk management, using structure to guide your decisions and not emotion. Let's look at the daily chart of gold from April the 1st and break it down step by step. Now, when we look at the sharp acceleration higher in gold since April the 1st, it was consistently posting new all-time highs, it's obviously difficult to establish where resistance points may stand. However, Fibonacci extension calculations did prove useful in highlighting possible levels where the advance may stall, even correct back lower from. If we run the extension calculations off of the initial large sell-off, which was seen from the April 21st high at 3,500 down to the May 14th low at 3,120, we can see initially the extension levels didn't offer many clues in terms of resistance. The 100% extension saw a brief pause in price strength, but it wasn't long until this gave way on a closing basis and the advance resumed. Now, in this situation, it's fine. Don't forget, breaks of Fibonacci extension levels represent breaks of a resistance, and as such, is a confirmation of the ongoing positive momentum, which suggests scope for a move to continue to higher levels. However, look at what happened on October the 16th, the 19th, and the 20th. Each session saw attempts to break above 4,383, which was the level of the 238.2% Fibonacci extension level resistance. It was from this area that the latest sell-off materialized as a reaction to overextended upside price conditions was finally seen. If we hadn't calculated or recalculated the Fibonacci extension levels using that significant correction move back in April-May, we wouldn't have known of the potential resistance at 4,383. Now let's look at the same chart, but this time calculate the Fibonacci retracements on the strength seen between the May 14th low at 3,120 and the October 19th high at 4,381. Now, the sell-off from that resistance area at 4,383 was held on a closing basis by support provided at 3,903, a level which is equal to the 38.2% retracement of that May to October price advance. So, in conclusion, by understanding both Fibonacci retracement and extension levels and applying them to significant highs and lows in price action, you can gain a powerful tool for identifying potential support and resistance zone for any CFD. These levels aren't just theoretical, they're practical tools you can integrate directly into your risk management strategy. When you plan your trade in advance, they can support you to define your entry point, your stop loss level, your capital at risk, and your take profit objective. The good news, by utilizing this approach, you're not just trading, you're executing a structured plan with a clear risk to reward profile. This disciplined approach helps you to stay consistent, protect your capital, and trade with confidence, no matter what the market throws at you. Right, that concludes the presentation part of the webinar. I can see that there are several questions already, so let's look at them with Richard.